Every country on Earth owes money. The United States owes more than any nation in history. But here's what should make you stop and think. If everyone owes money, who exactly are they owed to? The answer reveals a system that most people completely misunderstand, and once you see how it actually works, you'll never think about money the same way again. This is the story of who holds America's debt and why the answer changes everything. 2 types of debt. The national debt can be broken down by whether it is debt held by the public or intergovernmental holdings. Debt held by the public includes everyone outside the federal government, foreign countries, American banks, pension funds, individual investors, and intergovernmental debt, which is money the government owes to itself. As of early January 2026, the federal government has about $38.4 trillion in total outstanding debt. According to the U.S. Treasury, the national debt is the total amount of outstanding borrowing by the U.S. federal government accumulated over the nation's history. Public debt represents real obligations to outside investors who expect to be paid back with interest. Intergovernmental debt is accounting between government agencies. I owe us. The Treasury writes to Social Security and Medicare when those programs have temporary surpluses. Both are legally binding obligations, but they create different pressures on the system. How borrowing works. To finance budget deficits, the federal government borrows money by selling marketable securities, such as Treasury bills, notes, and bonds. The U.S. Treasury explains that the national debt is the accumulation of this borrowing along with the interest owed to investors who purchased these securities. When the government needs money, it issues Treasury securities in different forms: bills that mature in less than a year, notes that mature in 2 to 10 years, and bonds that mature in 10 to 30 years. These are promises to pay the buyer back with interest. A 10-year Treasury note pays interest every 6 months and returns the principal after 10 years. Investors buy them because U.S. Treasuries have a long record of being repaid in full, which makes them the global standard for safe investments. Banks need them for regulatory requirements. Pension funds need them for steady returns. Foreign governments need them to manage their currency values. Individual Americans buy them through Treasury Direct or savings bonds. This constant demand allows the government to keep borrowing. When existing securities mature, the Treasury issues new ones to repay them. This process continues indefinitely, which means the debt is not paid off in aggregate. It gets rolled over. The debt ceiling sets a limit on total borrowing. When the government hits this limit, Congress must vote to raise or suspend it so the Treasury can continue issuing securities. This creates the political standoffs you see in the news, where Congress threatens not to raise the ceiling even though the spending has already been approved. The ceiling doesn't authorize new spending. It just allows the Treasury to borrow money to pay for what Congress already decided to spend. Now here's where the story shifts. Because once you understand how the government borrows, the next question becomes unavoidable. Who is actually on the other side of those transactions? Within the $30.8 trillion in public debt, the breakdown reveals where the money actually comes from. American investors hold a significant portion through banks, pension funds, mutual funds, insurance companies, and individual purchases. The Federal Reserve holds about $4.2 trillion. Foreign investors hold around $9 trillion. Banks buy treasuries because regulators require them to hold high-quality liquid assets, and treasuries are the safest assets available. When a bank holds treasury securities on its balance sheet, regulators count them as proof the bank can withstand financial stress. This regulatory demand creates a built-in buyer for government debt. Pension funds buy treasuries to generate steady returns for retirees. A pension fund promising to pay someone $50,000 per year in retirement needs safe investments that produce reliable income. Treasuries fit perfectly because they pay interest on a fixed schedule and have virtually no default risk. Insurance companies hold massive amounts for similar reasons. An insurance company collecting premiums today but paying claims years or decades from now needs somewhere safe to invest that money while it waits. Treasuries are liquid, meaning they can be sold quickly if the company needs cash to pay unexpected claims. Individual Americans buy treasuries directly through savings bonds or Treasury Direct. If you bought a savings bond as a gift or invested in treasury securities through your brokerage account, you're part of the group holding U.S. debt. This isn't foreign powers buying up America. It's Americans lending money to their own government. The Federal Reserve holds about $4.2 trillion in treasury securities, but this works differently than any other investor. When the Fed buys treasuries, it doesn't use existing money. It creates new money to purchase them. Here's the mechanism. When the Fed decides to buy $1 billion in treasury securities, It credits the seller's bank with $1 billion in newly created reserves. Those reserves didn't exist before. The Fed simply adds them to the bank's account electronically. This expands the money supply without taking money from anywhere else. This happened on a massive scale during the 2008 financial crisis, and again in 2020. During the mortgage crisis, the Fed bought over $2 trillion in treasuries and mortgage-backed securities to stabilize markets and lower interest rates. In 2020 and 2021, when the pandemic hit, the Fed bought an additional $4 trillion. The Fed's balance sheet expanded from under $1 trillion before 2008 to over $8 trillion at its peak in 2022. When the Fed holds treasuries, something interesting happens with interest payments. The Treasury pays interest to the Fed on these securities, just like it pays interest to any other bondholder. But in normal times, the Fed remits most of its net earnings back to the Treasury. This creates a circular flow where interest payments loop back to the government. Over time, much of the interest on Fed-held debt effectively flows back to the government, which is why Fed purchases effectively reduce the government's borrowing costs. Recently, this changed. As the Fed raised interest rates to combat inflation, it started paying more interest on bank reserves than it earned on its older, lower-yielding Treasury holdings. This caused the Fed to temporarily suspend remittances to the Treasury, but over the long run, most interest on Fed-held debt flows back to the government. Foreign investors hold around $9 trillion in U.S. Treasuries, which sounds enormous until you calculate the percentages. That's less than 1/3 of public debt and about 1/4 of total federal debt. Japan currently leads foreign holders at roughly $1.19 trillion, followed by China at around $700 billion. Other major holders include the United Kingdom, Luxembourg, Ireland, and Brazil. China's holdings have declined significantly from their peak, above $1.3 trillion in 2013. The common fear that China owns America through debt holdings misses the scale completely. China holds roughly 2% of total U.S. debt. Even if China reduced its holdings sharply, domestic investors in the Federal Reserve could absorb a large portion of the supply without destabilizing the system. These countries buy U.S. Treasuries for specific reasons that have nothing to do with controlling America. First, they're safe stores of value for foreign exchange reserves. When a country accumulates dollars through trade, it needs somewhere to park those dollars, and Treasuries are the safest available option. No other asset combines the safety, liquidity, and return that Treasuries offer at this scale. Second, holding Treasuries helps countries manage their currency values. When China exports goods to the U.S., it receives dollars in payment. Chinese companies need yuan to pay workers and suppliers, so they exchange those dollars at Chinese banks. The Chinese central bank ends up with the dollars and needs to invest them somewhere. Buying treasuries helps manage the exchange rate between the yuan and the dollar, which affects trade competitiveness. If China let those dollars flood into yuan without buying dollar assets, the yuan would appreciate rapidly, making Chinese exports more expensive and less competitive in American markets. By buying treasuries, China maintains demand for dollars, which keeps the exchange rate favorable for its export economy. The key point is that foreign holdings represent a minority share of U.S. debt. The U.S. overwhelmingly owes money to itself and to American investors, not to foreign powers. The remaining $7.6 trillion in intergovernmental debt is what federal agencies owe to other federal agencies. Social Security holds about $2.8 trillion in special Treasury securities, making it the largest holder of intergovernmental debt. Here's how this works. Social Security collects payroll taxes from workers, about 12.4% of wages up to a certain income limit. For decades, those tax collections exceeded benefit payments because the ratio of workers to retirees was higher. The surplus accumulated, and by law, Social Security must invest that surplus in special non-marketable Treasury securities. These are IOUs, from the Treasury to Social Security, and they pay interest just like regular Treasuries. Social Security earns a return on the surplus, which helps finance future benefits. Medicare, military retirement funds, and other federal programs follow the same process when they accumulate surpluses. But this creates an accounting entry where the Treasury owes money to Social Security, and both the asset and the liability sit within the federal government. The government wrote an IOU to itself. This works fine as long as Social Security has surpluses to invest, but the system reverses when Social Security needs the money back. Starting around 2010, Social Security began running cash flow deficits, paying out more in benefits than it collects in payroll taxes. To cover the gap, Social Security redeems its Treasury securities. The Treasury must find money to honor those IOUs, either through current tax revenue, by borrowing more from the public, or by having the Federal Reserve create new money. This is where intergovernmental debt creates real budget pressure, because what was once an internal accounting entry becomes actual cash that must be found. The debt grows because spending exceeds tax revenue consistently. In fiscal year 2023, the federal government spent about $6.1 trillion, but collected only $4.4 trillion, creating a deficit of roughly $1.7 trillion. That deficit gets added to the debt. Mandatory spending on Social Security, Medicare, and Medicaid grows as the population ages. The ratio of workers to retirees keeps falling, which means fewer people paying into these programs and more people drawing benefits. Defense spending remains around $800 billion per year, and net interest costs exceeded $650 billion in fiscal year 2023, rising rapidly as both debt and interest rates increase. Here's where it compounds. As the debt grows, interest payments grow with it. When interest rates were near zero from 2008 to 2021, the government could borrow cheaply despite growing debt. But as the Fed raised rates to combat inflation in 2022 and 2023, new borrowing became more expensive. Higher interest costs increase deficits, which require more borrowing, which increases the debt, which leads to even higher interest costs. Tax revenue doesn't keep pace. Tax cuts reduce revenue directly. And when the economy slows, tax collections fall because people earn less and businesses make lower profits. Neither political party has shown willingness to make the hard choices needed to close the gap between spending and revenue. So the debt keeps growing. Whether this debt can continue indefinitely depends on interest rates, economic growth, inflation, and investor confidence working together. As long as investors worldwide view U.S. Treasuries as safe, demand remains strong, and the government can keep borrowing at manageable rates. The dollar's role as the world's primary reserve currency reinforces this demand because international trade and financial markets rely heavily on dollar-denominated assets. Oil is priced in dollars. Most international transactions are clear in dollars. This creates structural demand for treasuries. Economic growth matters more than the absolute size of the debt. When debt grows faster than GDP, the burden increases. Debt held by the public has risen from about 35% of GDP in 2000 to over 100% today, approaching levels last seen during World War II when the government borrowed massively to finance the war effort. The Congressional Budget Office projects that debt held by the public will rise to 156% of GDP by 2055 under current policies, assuming no major wars or severe economic crises. If another crisis hits, which history suggests is likely, the debt could reach even higher levels. Inflation affects the real value of debt in a way that matters enormously. The government borrows in nominal dollars and repays in future nominal dollars. If inflation runs high, the real value of those future dollars falls, which effectively reduces the debt burden. This is why moderate inflation benefits borrowers, including the government. The government owes $38 trillion nominally, but if inflation runs at 3% per year for a decade, the real value of that debt falls significantly, even though the nominal amount stays the same. Government debt is not designed to be paid off. It's designed to be rolled over and managed. When Treasury securities mature, the government issues new securities to repay them. This process continues indefinitely. The real question is whether the government can service interest and roll over debt without triggering inflation or losing investor confidence. This is fundamentally different from household debt. You can't print currency, and lenders won't lend to you indefinitely if your debt keeps growing. But a government that issues its own currency operates under different rules. It can always make payments in that currency, which is why the U.S. has maintained an exceptionally strong record of honoring dollar-denominated debt. The real constraint isn't solvency. The U.S. can always print dollars. The real constraint is inflation. If the government tried to pay off the $38 trillion by collecting $38 trillion more in taxes than it spends, it would remove $38 trillion from the economy and cause a massive contraction. GDP would collapse, unemployment would soar, and the economy would enter a depression worse than the 1930s. Additionally, treasuries serve as collateral for much of the financial system's lending. Banks use treasuries as collateral for short-term borrowing. Money market funds hold treasuries as their primary assets. The repo market, where financial institutions borrow overnight, relies on treasuries as collateral. Eliminating the debt would destabilize the entire financial system. History shows that when money creation outpaces real economic output, currencies lose value. That's what happened in Weimar Germany when the government printed massive amounts to pay war debts. It happened in Zimbabwe when the government printed to cover budget deficits. It happened in Venezuela when the government printed to finance spending it couldn't afford. The danger isn't that the US cannot pay, but that paying requires so much money creation that it triggers inflation that destroys the currency's value. The US carries $38.4 trillion in federal debt. Roughly $30.8 trillion is held by the public, including American investors, the Federal Reserve at $4.2 trillion, and foreign holders at around $9 trillion. The remaining $7.6 trillion is intra-governmental debt, largely owed to Social Security and Medicare trust funds that will eventually need to be redeemed. The debt continues to grow because spending exceeds revenue by $1 to $2 trillion per year, and interest costs are rising as both debt and interest rates increase. The question isn't whether the debt will be paid off, because it won't be under the current system. The question is whether it will be managed well enough to preserve confidence. That's the reality of who owns America's debt and why it matters. Not because China is buying America, which isn't happening, but because the system depends on a delicate balance of confidence, growth, and inflation. And that balance becomes harder to maintain as debt grows faster than the economy that supports it. America's debt isn't a foreign threat. It's a mirror, reflecting how growth, confidence, and inflation hold the entire system together. And history shows that when that balance breaks, empires don't fall overnight. They unravel in stages. If you want to understand where America fits in that pattern, watch the 7-stage empire death cycle: Rome, Spain, Britain. America is next.